So the 5 points that I'd like to talk about today is firstly a more general piece on managing money. Should there be a preset strategy? Secondly, on the economy, what are we seeing? Thirdly, markets, and then an update on Brexit, and then finally a detailed piece on banks and credit. So today, point 1, should there be a preset course for investing money? Our view, no. The analogy I want to use is Mark Carney. He said this week there's no preset course for monetary policy. He's talked about higher rates in the past. He's even talking potentially about lower rates now. We think that's quite right. So at Coutts, there's no preset course. Instead, we'll respond to both valuation and market fundamentals. Point 2, economics. What are the signs of recession? We're looking carefully to ensure that our view that there's no recession in 2016 comes through. We've seen data in the UK, US, Europe, mixed, points to some weakness in some areas, but definitively no recession. Point 3, in terms of markets, we've seen some stabilization, in particular in the UK equity market, and we're seeing continued strength in government bonds. Coutts' view is that equities will recover. We may have seen the bottom, but generally we think it's positive for risk assets. So point 4, re-Brexit. It's been all about the currency this week, as sterling dollars approached 140 and in fact traded below 140. Our view is that it'll continue to be the key indicator to focus on, not gilts, not the equity market. And in general, our view is at these levels, Coutts' view at these kind of levels, it's too late to sell sterling at 30-year lows. So point 5, where do we see the specific opportunities? And I'm going to spend a bit more time on this one because this is something we're working on in Coutts' portfolios right now. So we're looking at sectors which are discounting, in our view, recession, where we don't see a recession at Coutts. And that tends to be, right now, financials, in particular banks and credit. They're closely related, so let me focus on the bank side. In terms of banks, why are we positive on banks? Firstly, we think the negative impact to banks from negative interest rates is overplayed. It is a negative, but a small negative. Much more important is a stable economy, loan growth, which we're seeing globally, and very depressed valuations. So banks and credit are very, very attractive in our view.